Guess I'll start letting people in. There we go. Hello, guys. We're going to let a few more people come in. I feel like we need to give it a little more time. We don't have too many people in here yet. And Tiffany, I'm going to allow your mic just in case you need to say anything.
Good morning, everybody. Can you hear me?
Tiffany.
Yep.
First of all, I just want to say thank you to everybody who is on the screen. And it looks like we've got some people who are live too. I'm not really sure what the numbers are, but Nathan and Matt are fantastic in this space. And I'm so looking forward to hearing what you're going to tell us this morning. So appreciate you guys, great members and great colleagues. So let's have a great webinar.
Thanks for having us. Thanks for saying that.
Thank you, Tiff.
All right. Do we want to go ahead and get started? I want to make sure we have time for questions and stuff later, and I'm sure some people will be coming in throughout. What do you guys think, Nathan and Matt?
I'm ready.
Okay. All right. So we don't have a huge crowd today just yet, but we'll give them some time. But I wanted to thank Nathan and Matt for being on for our reverse webinar today. I know we haven't had a webinar with National Mortgage Bankers in a while, so I'm excited to be back on with you guys and see everybody's faces. What we're going to do, we're going to have a Q&A and a chat open. If we have any questions during it, just pop those in the chat, and then once they both get finished with their slideshows, we'll have them and I'll read them off if we need any specific questions. If you need to be unmuted, just let me know. If you would just rather ask, just raise your hand and we'll get all that figured out. But just pop in the chat anything you need from me or any questions for them, and we'll get rocking and rolling. So I think we're going to start off with Nathan. And again, with National Mortgage Bankers, if any of you guys are not members already, please reach out to any of us and we'd be more than happy to help you get signed up and have you, come to a meeting with us or anything like that. So Nathan, we're going to go ahead and start with you. And then whenever you need me to share your slide, you just let me know.
Sure. Well, first of all, thanks everybody for if you're attending, and thanks so much to National Mortgage Bankers for allowing us to be able to chat just a moment about something that we're passionate about. I'll start off by giving you a little bit of background on our company. We began in 1986 here in Chattanooga, Tennessee. In 1993, the previous owner of the company, Don Oakes, who's a past president of TNBA, worked with the state legislature and Tennessee Mortgage Bankers to get the first reverse mortgage approved in the state of Tennessee. We had the very first client, closed the very first one, and since then we've done about 3,000 of these loans. So it's all that we do. It's the only loan that I've ever done. So we've really just created a nice niche business over a long period of time. We have a lot of advisors, people we deal with, and so it's been a good thing for us and something I've really enjoyed through my career, 15-year career. I think the first thing that I'd like to highlight, most important reason why, in my opinion, we're really having this discussion and why it needs to be a broader discussion, in my opinion, is the fact that reverse mortgages and people being able to use their equity in retirement is going to be absolutely critical, not only now, but into the future for multiple reasons. Pensions, as most of us know, have nearly gone by the wayside. Unless you're working for a very large corporation, usually union style jobs, or you maybe work in the public sector, pensions are gone. My mom's a retired teacher. She's got one. It's been beautiful for her. But for most of us, that's not something that we can access. Number two, because pensions are gone and it has become more and more our responsibilities as individuals to contribute to 401k plans. And we all know life events happen, whether it's illness of a child, whether it's divorce, you name it, layoff. People end up a lot of times raiding those retirement accounts. And when it comes down to it and they get to retirement or a period of time where they can no longer work, then they're left with Social Security and whatever assets they have. And many times, okay, one asset that people do have and have seen appreciate a lot, like all of us who've owned homes over the last 4 to 5 years, is a house. And whether they have a mortgage on it or they have it paid for free and clear, that's something that if they're uneducated about the reverse mortgage loan, they may never be able, or they may never leverage it, and they may in actuality suffer because they didn't, have the opportunity or did not pursue education in the loan. So it's important for us all to consider, okay, look, what is retirement going to look like into the future? All assets need to be on the table. It's going to be a bigger issue the longer things persist and the more people that retire. So home equity is going to be a big part of that, and that's really what we do and what we serve. So when you look at the loan itself, one thing you need to understand is this is an FHA insured loan. It's not an exotic product that people can do on the fringes. It should be very mainstream and not as much participation as we'd all like to see, but it is definitely a loan that provides a lot of protection for the individual, for the estate. Someone can leave the home to their estate just like they can with any other property with a loan on it in the state of Tennessee. They have the right to have folks live with them to improve the property. It's really just a mortgage. If I can get anything across today, this is a mortgage. Okay. It has to be satisfied if someone ever decides to sell the home. If they pass away, their estate has up to 12 months to sell the home, pay it off, keep the difference, or to refinance it themselves and just maintain the property on their own. Again, it's just a loan, and there's a lot of safeguards in place for the client. There's independent counseling that's mandatory in the state of Tennessee before an application can even be taken. They have to go through third-party HUD counseling. So there's a lot of that in place. A big piece of this FHA insurance is something that I want to talk about briefly, and I think it's critical to the loan and it's critical to the client. In our particular loan, it's a no recourse loan, meaning that if there is an estate and for some reason, which is highly unlikely in today's world, but it could happen, if the property value is ever less than the loan, the estate is not liable because FHA is insuring that difference would be paid. So the estate would not be liable even if the folks have other assets. The estate's not liable for it. Neither are they personally liable for it. So if they had to leave the property, they could no longer maintain the property as their primary residence, which is a guideline to have the loan. Even if they have funds to pay for that long-term care, the reverse mortgage can never be attached to them personally. But probably the biggest part of the insurance, or it's a very critical part of it, is the fact that the funds that are available to the client. What I do with someone that comes to me and has a home that's paid for, or nearly all the way paid for, the mass majority of those folks, I suggest we will just open up a reverse mortgage line of credit. Works very much like a HELOC, home equity line of credit. They can take what they need at closing, but I tell them, hey, let's be a good steward of what we have so that we have money now and into the future. The line of credit just waits there in the wings until they need funds, and then when they request them, they're direct deposited into their account to pay for home maintenance, maintain their standard of living, home health care needs, whatever they need, they can access that line. But the line is sitting there and it's actually growing for them the entire time that they're not using it. So, and there's no taxes that are associated with it because it's considered a loan. Okay. And that line's sitting out there, but FHA insures that line, which is critical, because when somebody does this and they think, okay, if I need this 15 years from now, and we happen to be in a major recession, and most, lenders with a traditional HELOC would have pulled that access back. Right now, they may not have it right when they need it. Well, FHA is ensuring that always to be there and always be growing for them, so that they know the ball field that they're playing on the entire time they have the loan. Okay, and they could wait later on if they need to kick in a distribution to their monthly income. That can be done. They can change plans. There's just a lot of things that can be done with this loan to be structured to help somebody as part of a financial plan. Okay, and I work with quite a few financial advisors, and they have clients from all over the financial spectrum. If I can say another thing, that this is not just a loan of last resort. Okay. There's plenty of people that have saved for retirement, but have not saved enough. And when most of us, have run the retirement calculators, unless you have started, planning for retirement and properly investing in the market in your early 20s, very likely it's pretty difficult to hit that number if you've had kids, family, and mortgage and car payments the whole time, right? So when someone's looking at their net worth and they're looking at what their assets are, adding in that reverse mortgage line of credit as another backstop to whatever other retirement assets they have can sometimes increase their access to funds by 25 and 30%, just depending upon how much they've been able to save, especially when those assets are in taxable retirement accounts, that every time they want to liquidate, some of that to generate some additional, funds for living, they're having to pay taxes on it, unlike when they decide to tap their reverse mortgage line of credit. So that's another thing that's very important, is to know that this is no longer a loan of last resort. It's a critical part of retirement and future retirement for the country at large. Okay. So that's another thing is that I haven't really touched on is, how is this loan used outside of just people aging in place? Okay. Many people don't understand that this loan can be used for actually purchasing a property, which is unique. We've done by far more than any of by far the majority of these loans, probably in East Tennessee over the last several years, as a brokerage shop for sure. So we have a lot of experience working with real estate agents. If you want to hit that slide for me, I'll kind of go over a little scenario. Okay, we're going to take a look at a scenario of somebody that's in retirement and they're wanting to move closer to be next to family, which in the Nashville market, Chattanooga markets, happens all the time. People decide to leave different parts of the country, out west, Colorado, California, and move to an area like Nashville or Chattanooga. Maybe they've had a relocation. Their companies moved headquarters, so they come. And when they come, they may be leaving family, especially grandparents that want to be close to their grandchildren and their kids, be a part of their life and help. So in this scenario, we have Glenda, age 72. Okay. And Glenda has some retirement savings, but she also has a home that is now worth $650,000. She has a mortgage she has to pay off. So after she pays off that mortgage, where she's at, after paying off the $150,000 mortgage, she has $450,000 available to her, okay, to purchase a new home in Nashville. Now, when she's looking, okay, now I got $450,000, I make $4,500 a month, and I would really like to keep my nest egg intact. I'd love to be able to know that that $500,000 that I've been able to accumulate is going to be there and still accumulate for me. I like not to tap into that because I'm gonna have to pay taxes on it when I do so. So how can I accomplish getting to Nashville with a $450,000 budget? Well, depending upon where the kids live and the proximity they want to be close to the kids, that could be difficult. Okay. So she does find a place close to her kids. And if we look at the kind of a pink screen there, we can see the conventional side of mortgage, or the reverse mortgage side on the screen to the right. On the conventional side, she's got a $650,000 property that she's looking at to purchase, and she's got a loan amount of $200,000. She's got to come up with $200,000. Okay, her cash to close, all right, $458,000. Okay, $458,207 with a monthly payment of $1,381. All right, and that's principal and interest before escrows. And our monthly income of $4,500 with a DTI 32.5%. And she'll need to pull $8,500, from savings in order to complete the purchase, and no funds left over for moving expenses. Now, so she'd be able to do that. She'd have a monthly mortgage payment. She'd continue to live in just like, a lot of people do in the traditional sense. But if she said, you know what, I don't want a mortgage payment. How can I do this with just using the $450 that I have? Well, she could look at doing a reverse mortgage to purchase a home. And so if you look at that far piece to the right, we have a $650,000 property. Okay. The loan amount from the reverse mortgage is $260,000. So she would have to bring $421,000 from her $450,000. So she's got to bring $421,000. She has no monthly mortgage payment. She's just responsible for taxes, insurance, HOA dues, and maintenance until she decides to sell the property, or she were to pass away and leave it to the estate. At either point, she or the estate could sell the property, keep the difference. Okay, but no monthly mortgage payment along the way, which is cash flowing her an extra close to $14,000 a year. And so her monthly income is $4,500, and we're not subtracting that $1,381. She gets to continue to live off of her pension and Social Security. Okay, so she has no required monthly mortgage payment. She has $29,000 left over. We subtract what she needs to close, the $421,000 from the $450,000. She got nearly $30,000 left over, and that's going to really pay all of her moving expenses and have a little money left over. So she's going to be able to live in that house, and that $650,000 house. And when I really talk to my clients and I pull up an amortization chart for them, I show them, look, yes, that loan amount of $260,000 will grow over time because interest accumulates, right? There's an interest rate on it that accumulates over time. So if she's not making a payment, that $260,000 is going to increase. Our balance is going to increase. But if we have just a basic appreciation of 4%, which FHA depends upon really in order to insure this loan, on that $650,000 house, we're looking, in 10 years at that $650,000 house being worth, $850,000. Her loan may be sitting, somewhere around $400,000 to $430,000. But there again, when it comes to amortization chart, and I talk to my clients, and what we project is a break even on equity through the life of the loan. So if she's initially, just use a round figure, if you initially have $300,000 in equity, because the home is going to appreciate over time, and in 10 years, you should still have close to that $300,000 in equity mark. So we've got to keep in mind that home's going to continue to appreciate over time, and that's a big part of what we're dealing with, and kind of part of our planning. So, we I know that was a fast overview of that. There may be a lot of questions. Happy to ask there, at the end about this particular piece. But it's just important for people to know that there's even this option that's out there. Many times when I have somebody approach me, they say, well, I didn't even know you could do that. Well, many people don't understand it or don't even know that it is a program that's available, but that's why it's important to explore all options and meet people where they're at. Um, uh, I really don't have any other slides. I know that I've probably said a lot. Um, uh, my primary means of dealing with my clients are face to face. This is a very personal process. There's multiple appointments, talking with financial advisors, tax professionals, family members many times meet 3 times throughout the process. So the technology piece maybe be one that I could polish up on a little bit, but just our business model has been dealing with people face to face and families for a long time, and we're here to help any way that we can.
Awesome. Thank you so much, Nathan. And his QR code's up here if anyone wants to scan it. But I will let you know our chat is apparently not working, so use the Q&A option if you can. But this is also going to be recorded, so if anyone needs any other information or access to Matt or Nathan, just let me know. I'm going to stop sharing. And Matt, you can go ahead and take it away whenever you're ready, and then we'll have some questions at the end if we have any.
All right, thank you. Let me try to share my screen here. You guys see that?
We can.
All right. Well, thank you guys for having me. I've met most of you guys, but my name's Matt. I'm here locally at the office in Nolensville, and this is my 18th year in the mortgage business. And kind of give you a little background on my journey. I'd worked with a client, and she called up, and she was panicking, and she said, "Matt, my body's telling me that I need to retire, but my bank account and my investment portfolio tells me that I'll never be able to retire." And I'm sure some of us in the mortgage business probably feel that way currently, but you guys know that feeling. She said, "But you helped me a long time ago on a early payoff mortgage. I've only got 10 years left on my mortgage. I have this house. Should I do a HELOC? Should I do a cash out refinance?" And I said, the challenge is those are going to have expensive payments. There's some other options out there. If you're open-minded, could we share with you, there might be a better way for you to do this? And fortunately, she was open-minded. 30 days later, she had $100,000 in her bank account. She had a $100,000 line of credit, and she was retired when she didn't think it was possible. And kind of through that journey, we got so passionate about this product that we created if you see on the screen, we created a podcast that it's very, very rarely talks about reverse mortgage, but it talks about serving seniors, because we found through that process that these folks a lot of them are forgotten, and they don't have time to catch up on retirement. They don't have the ideas, they don't have the strategies. So we created this podcast just to help seniors get the information they need, and businesses that help seniors get the information they need. And so my goal today is, if hopefully you guys get as passionate about this product and program that Nathan and I are, where I could teach you how to do it, and you would actually want to serve seniors, because it's the phrase rising tide lifts all boats, right? If there's more people understand this, more people doing it, it's just going to increase the awareness and help more seniors. And then if a lot of folks in the mortgage space decide that this is either too complicated, or they don't want to get involved with this, they'd rather have an expert do it, then we could always help you with a client. But hopefully you guys get as excited about this as we are, where you would want to take this on and really, really help these folks. Here's our goal. to give you guys a little background, this is the lens that we put everybody through. We call these the 4 Ls. So what we do is we want to make sure that our seniors have the ability for longevity. Now, I know I can't see your hands, but does anyone have a fear of public speaking? Go ahead and speak up. I know Casey does. She's very shy. Very, very shy. Casey, public speaking?
The most shy in the group. How'd you know?
That's right. Well, fortunately, seniors' fear isn't public speaking. You guys see the first L right there? Longevity, right? So the biggest fear seniors have in this world is running out of money. So we kind of walk through how this may be able to help them. Another fear seniors have is lifestyle. Well, what if I retire and I'm not going to be able to enjoy life the way I have? That's a big concern. And then if any of you have looked into long-term care insurance, most people in their 30s, 40s, and 50s, once you get the bill, the price for it, or how much it would cost, a lot of people say, I'll worry about that later, right? And then, as we all know, if we have grandparents or family, those unforeseen situations hit and they need liquidity, and they don't have long-term care insurance, and maybe they haven't invested the way that they thought they should have. And then if they've done really well, we show clients how to leave a legacy. So when we're talking to clients, we kind of talk through the 4 Ls, if that makes sense. So if you guys understand, like Nathan shared with you, how it's a great product, it helps people out, lots of advantages, then why in the world is there so many concerns? Or why doesn't everybody do this? Because I'm sure Nathan's just like I am. The day I hit 62, I'm going to be closing on my reverse mortgage. That's how passionate and how much I believe in this product. But why isn't everyone like that? Well, there's a few reasons why. Casey, can you see that screen?
Yep, we can.
Okay, perfect. So here's really what holds people up, and what I wanted to share with you guys is there's misconceptions. Nathan and I, hopefully we carry a big voice, but we don't have as much reach as a Dave Ramsey or a Susie Orman, and their voices really adding to the misinformation and misconceptions on this product, and keeping seniors from getting it. So here's kind of a few things that we noticed that really hold people back from taking advantage of this awesome opportunity. One is that a lot of seniors and advisors and loan officers think that the house has to be completely debt-free, completely paid off before they could do one of these loans. And that's actually a big misconception. Just like Nathan shared with you earlier, one advantage would be she can own a home and not spend $1,300 a month on her mortgage, which would be between 30 and 40% of her cash flow. She could have a house and not have a monthly payment. So if they still owe some money and have a good amount of equity, that could be a big advantage. Another misconception is that the borrower's heirs will be left with excess debt, and then they would have to actually write a check if their home sells and their home balance is more than the home. That's false. One of the big cool features here, especially in Tennessee, all these are FHA mortgages. So FHA covers the difference, meaning if they owe more than the house is worth, FHA takes the hit, but the family doesn't of the senior. So that is a big misconception. Another one we run across is a lot of seniors say, well, I'll no longer be able to sell my house. Well, you guys all have clients that sell their home with a mortgage. They get what's left over after the payoff. They use that money to buy another house, right? Well, as you saw from Nathan's example, that works well with seniors and reverse mortgages as well. So in this scenario, they could do a reverse mortgage. They could live there for 10 years. They would still have equity, sell the house, and they would cash in on everything. So it works just like a regular mortgage. Another misconception is the lender takes ownership of the home. Completely false. They just have a mortgage on the house, sell it whenever they want, just a lien on the property, pay the lien off. And then the last one, as Nathan mentioned earlier, reverse mortgage is used as a loan of last resort for seniors without assets. So just to give you an example, we had a client that came to us from a loan officer in Lebanon. They were looking at a house in Florida. The house, once they went through the numbers, the HOA taxes, et cetera, are going to have about a $5,000 or $6,000 a month mortgage payment. The gentleman had $2.5 million in his portfolio, and he didn't have that in his portfolio, but making bad decisions. He said, I can make more money on my money than I can by spending $5,000, $6,000, $7,000 a month on this mortgage. I want to take advantage of this reverse mortgage. So gentleman had $2.5 million in his portfolio, and he still did a reverse mortgage purchase in Florida. So lots of opportunities, but lots of misconceptions. Hopefully that makes sense to you guys. And then another big question we get is well, why don't they just do a HELOC, right? Kind of sounds like a HELOC. You get some money, you have access to it. So this is a little example that we like to use when we're talking to folks about the difference between the HELOC, and the official name of the program is HECM, which is Home Equity Conversion Mortgage. So there's some big differences. Number one is that the HELOC, as you know, from most of you guys work at banks, requires a monthly payment. So the HECM actually does not require payment, but they can make a payment. So that's a big advantage to seniors, especially on a fixed income. They have the ability to not make a payment. I call it payment optional. So that's a big difference. Number two, the line of credit growth. So on a HELOC, as you know, whatever you're approved for, that's what you're approved for. On these, they work a little different. If you don't use the line of credit, the line of credit grows. So you think of it as if your credit card every year you get a balance increase. That's the way this works. Every year the unused portion of it grows. So that way they don't have to refinance and they could always get more money. So it's a great option for folks to do in-home care in the future. If you didn't get around to your long-term care insurance, seniors can actually use this loan, do it at 62 and let the line of credit grow and have that money sitting there. It's going to double in probably 10 or 12 years. The amount available could double for a senior, which could be a big deal. For those of you that were in the business in 2008, if you worked at a bank, I worked at a bank, and it was a daily occurrence where people asked why their line of credit, they couldn't get money out of it anymore. A lot of people don't know that, but look at accessibility. Line of credits can be closed. These cannot be closed by a choice of the lender. But as long as the borrower lives in the home, pays their taxes and insurance, they can't lose the line of credit. There's no due date like a HELOC. No due date, ending date. It's only due when the last borrower or eligible non-borrowing spouse leaves the home or passes away. There's no prepayment penalties, backed by the government, no annual fees. So it works really well for a senior compared to a HELOC. So Casey, I know that was a bunch of information, but wanted to leave a little time for questions here at the end. And I'll pull this up while we're getting. So if you guys have any questions, please get them ready. I'll leave you guys with a really cool example of a client that we helped. The names have been changed to protect the innocent, but this is Miss Connie Smith, age 69, normal middle Tennessee home, $400,000 home. She owed $52,000. She only made $40,000 a year. She needed to make 40, but she was only making 36. So with all the inflation, her taxes and insurance had gone up. She felt a lot of uncertainty, and her big motivation was, how could I have more money and save money at the end of every month? So here's what we were able to do. We paid off the mortgage. That was $572 a month. So her $40,000 loan, $52,000 loan went away, which saved her $572 a month. And she got a $93,000 line of credit. So as you could guess, if you kind of put yourself in the shoes of a senior, if you're watching, no matter what side of the aisle you're on, if you're watching CNN all day, if you're watching Fox News all day, it's death, destruction, wars, famine, elections, all this crazy stuff. If you had no mortgage payment and you had $93,000 you could tap into if things don't go as planned, put yourself in their shoes. What kind of peace of mind does that open up for a senior? And that's why Connie was excited to do this. So that's all I got for you guys. We're definitely love to answer some questions, and hopefully that got you excited about the ability to serve seniors and help them with this really cool tool that we all work with on a daily basis called home equity.
You guys did awesome. That was very informative to me. I've been learning about it a little bit. Let me put my camera back on. I've been learning about it slowly with Matt as my grandmother decided to Google reverse mortgage and sign up with some random company. So I gave Matt a call and I'm like, hey, do you mind helping my grandmother out? It's much better, especially when they are seniors, knowing that they have someone that I could just pick up the phone and talk to about it if he needs any help with anything, instead of some company out of Nebraska, I think it was Omaha or something like that. So make sure you're checking on them, that they're not just Googling random things and making random phone calls and giving their information to people like my grandmother did. So luckily Matt was there to help. But does anyone have any questions? I'm still going to be learning more about this along the way. But is there anything that anyone wants to add? If you do want me to unmute you, just raise your hand. If you can't get the Q&A or the question or the chat to work, and I'll have I can read it, or you can talk to Matt and Nathan and ask them whatever you want. Anybody got anything? Or any tidbits to add?
Hey, it's Tiffany. I did ask a question. How do you determine or calculate the loan amount? I mean, is it age, equity, a combination of, or how do you determine what their loan amount is going to be? Like, say it's, I don't know, free and clear, or that maybe they give me two options. Maybe they do have an existing mortgage.
Yeah, good question, Tiffany. You answered it almost. It's age, equity, how much they owe. It's a slide, and then what's going on with interest rates. It's basically a sliding scale. But most of the folks, if they're on the younger end, you're 25, 30% loan to value. If they're on the older, the current rates, if they were way up in years, you're pushing 40 to 50% loan to value. But it's a sliding scale.
Well, and it's really working on an actuarial scale that was developed by FHA back when they first, initiated this loan. In 2018, those of us that were in the business at that time and doing a lot of loans, they saw a big change. We saw them decide to take the interest rate and bake it into the loan, and that it was a big part of how much our clients are able to borrow. So as interest rates have gone up, it's suppressed how much we're able to lend. Okay. So when interest rates were at near zero, our lending limits were a lot more. We were able to help a lot more clients. So as the Federal Reserve has tried to tamp down interest rates, tamp down inflation, right? On the traditional side, they've caused mortgage rates to increase and payments to increase. So that sucks some of the oxygen out of the room, right? Well, on the reverse mortgage side of things, interest rates have gone up, suppressed how much we can lend. So we can't loan as much as we could in a lower interest rate environment. So as we see interest rates go down, we're going to see our lending limits go up. So yes, it's based upon the person's age, the value of the property, okay, and the current interest rate.
And I guess another piece of the conversation is we see so many of our baby boomers and things of that nature are having to, with what's going on with properties, particularly like in Middle Tennessee, they're very expensive, but they're needing to either move closer to family members, or their family members are needing to move closer to them because of what you just talked about, because of care and, helping with family. And we see all those different things. This is something that is a topic that comes up a lot, but there's so many misconceptions that a lot of times it might actually be a good solution for a family, but everybody, kind of throws swords and darts at it, because it's like, okay, no, but that's going to eat up. Like, and I love what you said, like the legacy, what you leave. We work so hard to leave some type of financial legacy. We talk about generational wealth, and they feel as though this is an option that takes that away. Can you speak a little bit on that?
Well, I'll speak a little bit to that. And number one, I think it's important to talk to people about their home and how it appreciates over time, and talk to them and ask them the question, okay, how much did you buy this house for in 1992? right? Okay, you bought it for 150,000. Now it's worth 450. Now, in the current environment we're in, we're not seeing problems with residential real estate coming down the line. Maybe some commercial stuff. We don't know what's going to happen, but FHA banks on a 4% appreciation in order to keep this insurance going, right? And they've seen that over the entire time they've looked at their portfolio that since they've been insuring loans, which has been, I think, back in the 50s or earlier. Okay, so looking at that 4% appreciation over time, and they're banking on it. And I'll tell you a situation that where I was able to help some clients, and it was very unique. Was a purchase that we did um, up in Brentwood. Okay, so some folks had a home, had a financial advisor. They had kids. One of them was a retired. One of them was an active school teacher that unfortunately and lived in a trailer park. That's all she could afford, in Nashville. She was renting it and it wasn't a great one. And that's sad that our educators, and she's college educated, that was having to live in that situation. Okay. And other kids had a son that was over the deli department at a local food line. And his wife worked there too. So they were thinking, how can my kids ever have a home? How can they ever experience home ownership? And both of our kids were in their early 40s. So what we did was they sold their current home, took those funds that they had remaining after paying off mortgage. They had enough to do the reverse to purchase loan, and they bought a big enough home. Okay. It was about 4,000, 5,000 square feet, but it's big enough for everybody to live together. Okay. And their family could do that. The kids lived with them. And what the kids were doing is they were paying mom $1,800 a month, and mom's putting that money back into the reverse mortgage loan to help pay it down, because a lot of people don't understand you can make payments into this loan. She was paying that reverse mortgage loan balance down. The equity is continuing to go up because of appreciation. And what a lot of people don't understand too is that every time they made a payment into that reverse mortgage loan, they're opening up $1,800 of access to funds. Okay, because it's an open-ended line of credit. So every dollar that goes in can be pulled back out if needed. So it just was a way to solve a big problem. So when they pay that loan down, and if they passed away in 10 years and that $750,000 home that they bought was now worth close to $1 million, they've paid it down to 300,000. Okay. Or, when they pass and leave it to their kids. All right. Well, now if there's $700,000, there's $900,000 to be able to disperse to the kids to go buy their own home. Okay.
Mm-hmm.
So there's just a lot of options. I know that, but that was a very unique situation. And Gwen, she, we're friends, make a lot of friends, and keep close with our clients, but talk to her regularly, and, it's going great. So just thinking outside the box, those are the kind of things people are having to do now.
That's a good question, Tiffany. We hear that a lot. And what we try to urge folks to do is look at where you have the most zeros in your balance sheet. And most advisors would tell you to live off of that. Unfortunately, the most zeros on most people's balance sheets in today's world is their home equity. But they've not learned how to use that because of the misconceptions. So we had a client that we got a call out of Tullahoma, a husband and wife. They each made about $2,000 a month. One of them passed away, so the income almost cut in half. So she was getting $2,000 a month from a daughter, if you think through it. So the daughter was working, paying taxes, and then giving mom $2,000 a month. And then the son was paying the taxes and paying the insurance. So the financial advisor we got the referral from said, "Hey, what? You're a little slow on your investments lately. What's going on?" They're like, "Oh yeah, we're helping mom out." He's like, "Well, tell me the story." They told the advisor the whole story. He's like, "Well, tell me about the house." It was $450,000 completely paid off. And they were giving mom money to survive because she was trying to live off $2,000 a month. The advisor goes, whoa, 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 whoa. There's got to be a better way. You're paying taxes. You're not investing money, and mom has this asset completely paid off. So we worked through it. We were able to pay off the mom's HELOC. We gave her money to fix the roof. She's getting $2,000 a month. And if you think through how that helps a family, The daughter is now keeping her $2,000 a month to live off of. So her lifestyle's gone up. The mom now has money to live, and then the son doesn't have to pay taxes. They're investing money. So Tiffany, that's a great question. It's kind of retraining the mind that your home is usable if you have the right product in place and just using some of the equity. There's still equity, like Nathan said, to pass on to the next generation. But this just allows you to use some of the equity. They still own the house, they can sell the house, and they have the ability to change the whole dynamics of the family. So yes, there is some concerns with kids losing equity but there also is a lot of times it can help the family because this opened up a $450,000 bucket of money that they didn't think about using that made their life all a lot better.
And in my experience, really most of the time, to your point, Tiffany, it's about the client that's concerned about leaving whatever this asset is to kids. Obviously, there's all kinds of people out there and people have different thoughts, but most of the time the kids are doing well enough on their own that they don't care or want this asset. So it's just a personal decision that someone has to come to say, look, my kids are okay. This is something that we need to take a really hard look at to leverage for our benefit and our retirement. And then they got to come to terms with it. But and then that's when I talk to them about the property appreciating, and we're still going to be able to do those things if things go the way they've gone for the last 50 years.
Looks like we have someone with their hand up. Daryl, I believe. I think I unmuted or gave you mic access, so feel free to come off unmute and you can ask your question. Can you find the unmute button? Daryl, if you want to, if your mic won't work, you can just pop it in the Q&A and I can read off your question. Can y'all hear me right now?
Yeah.
Okay.
Yes. I think he's trying to be unmuted so he can speak.
Yeah, I gave him mic access. I think he'll just have to press the unmute on his end too. Caitlin, you may know better. You may be a little better at this than me.
No, you've done all we can do on our end. He'll have to unmute himself at this point.
Okay. I guess. Hopefully he can use the Q&A chat so we don't miss anything.
Hey, I was just about to text you. No, I can't.
Okay.
Get it.
Can you hear it?
Yeah, I can hear you.
All right, I'm putting you on speaker so you can ask your question. Okay, ask your questions.
The question I wanted to ask, can you talk to them about property taxes and maintenance on the home?
Did y'all hear that he was asking questions about property taxes and maintenance on the home?
Well, the property taxes and maintenance are part of the reverse mortgage loan, but it's really no different than any other loan. Okay. So if you have a traditional loan, you're responsible for your property taxes, homeowners insurance, basic maintenance of the property. Now, you're not going to have some representative from FHA come out and audit your property to make sure the paint's not peeling. The only time the lender is going to get involved is if the homeowner's insurance cancels because of deferred maintenance and sends them some notification letting them know there's a problem. Then they're going to reach out to the homeowner and let them have an opportunity to correct those things and get the homeowner's insurance back on the property. So yes, the taxes, insurance, maintenance are all part of the agreement. But there again, we go back to any other mortgage and look at that agreement, it's going to have the same verbiage in there.
Mm-hmm. Was that Daryl? Also, too, that just like any loan, you can include those in. Some of your clients with lower credit scores, it will be required that they're included. It doesn't change things. It only means that they have to have more equity because we have to use some of the money we would have given them to cover taxes and insurance. But a lot of folks actually want to have that taxes and insurance included. So the actual loan would pay taxes and insurance just like on any loans that you do on a regular basis. And then like Nathan was talking about, just keep the property up, but there is nobody coming by checking to see if they've kept it up in working order.
Yeah. And we try to avoid the tax and insurance set aside in a lot of cases, especially if you have a borrower that's shown their propensity, willingness, and capacity to pay those things over time, because we are going to earmark off a nice chunk of money that they won't have access to. Usually they want to set aside, called it's a lifetime set aside for taxes and insurance. And they're running out typically to about age 93. So you can imagine a 70-year-old, if we have to put a tax and insurance set aside on them, it's going to be pretty hefty. So that's one thing to keep in mind. It can be done, but they're going to need a pretty sizable amount of equity to do that.
The other neat thing about these loans, just so you guys know, is that they are not DTI constrained like a regular, but also not credit score. So we're working on several folks in the 400s and the 500s right now. So one big advantage to banks, if you guys are bankers and you have bankers that try to do HELOCs for folks that have questions, they've got a $400,000 home, they have medical bills, they have bills, they come to your bank to ask for a HELOC. As you guys know, it's getting tighter and tighter on those HELOCs. These really open up the bucket of lending options for seniors with lower credit scores, high debt to income, because that is not as important on these loans as it is on a traditional loan, but especially a HELOC.
Okay, thank you guys for answering questions. Does anyone else have any questions or anything we need to hit on before? And keep in mind this was recorded, so any information you guys need, you'll have access to, and we can get you in touch with Matt or Nathan anytime you need. I definitely learned a lot today, so I didn't know that they could do stuff with no payments and everything like that. So, and Nathan, I loved that story with the mom, I guess the parents and the two kids that were in their 40s. That's awesome. I never thought it could be, you could get that creative on it. I'm definitely going to keep that in mind. Yeah, good things to know for sure. Anyone else have anything? We're hitting our time almost, so want to make sure I give people time back in their day. Either way, thank you, Matt and Nathan, so much for coming to talk to us today. And if we need any kind of other deeper dive into this, maybe we'll have another webinar on this later in the future, and we can really get down to some nitty-gritty questions. And if anyone has certain scenarios, maybe run them by Matt and Nathan. But I'll go ahead and give you some time back in your day. Thank you, everyone, for hopping on with us today. And as always, if you have any questions regarding National Mortgage Bankers, please let us know. We'd be happy to help you and lead you in the right direction and have you at one of our meetings. But I think that's all for today. So again, thank you guys, and thank everyone for joining. We had a smaller crowd today, but hey, that's no problem. I think we all learned a little bit today. So I hope everyone has a great day and rest of your week. And if you have any questions, please feel free to reach out.
Thanks for having us.
Thanks.
Good to see y'all.
Bye, guys.
Good job,
Everybody have a
Nathan.
good day.
Take care.
Great
Take
job,
care.
y'all.
Bye-bye.
Yeah, you too.
Thank you so much.
Thanks, everybody.
Thank you, Tiffany. Great day.